I am Phil Henry. Friends and clients, welcome very much to our 2023 year in review and 24 advance. And I'm joined with a couple of guys I'm going to introduce in a minute. This doesn't look like my normal setup here, does it? I'm actually in a funeral home. My beloved Aunt Linda, God rest her soul, passed away a few days ago. So the guy that runs the funeral home was nice enough to let me use his office. So we had the 2 to 4 session, then the 6 to 8. So this worked out great. My aunt would yell at me if I canceled this webinar. So we're here. So thanks to the Truby Funeral Home for letting me use their office. I got a couple dynamic guests. That's all I can say, dynamic. Mike, I don't know where you are on the screen. Mike, would you raise your hand, please? Your name's, there's Mike. You can see his name. Okay. So Mike Storr joined us last time. He was with my buddy Greg Trzynski. Greg is not, Trasky, excuse me. Greg couldn't make today. So just a quick reintroduction of Mike. Been with Symmetry 16 years. Senior Regional Director, works closely with Greg. Resident of Boston, Mass. Graduate of Salem State University. Go Vikings. Married, 2 adult kids. Listen, we get along, except yes. He's a Boston, he's a Patriots guy, and he's a Red Sox fan. So other than that, welcome Mike Storr, and special treat, John McDermott, Dr. John McDermott. John, listen, John doesn't do many of these. I feel very special. You people should feel special. Dr. John is for the first 21 years of his life after graduating from U.S. Coast Guard, thank you for your service, John. He was with the Coast Guard. He retired as a commander in 2005. He soon thereafter began teaching finance at Fairfield State University in Connecticut, and also had a consulting gig with Symmetry Partners. He's still at both of these places. He's Symmetry, he's Fairfield. He's a great guy. He's the senior strategist. These are 6 people. They got CFAs, they got MBAs. He's an MBA and a PhD from UConn. Married, he's got 3 adult kids. Except for him being a Jets fan and a Mets fan, he's a great guy too. So really thankful to have John, Dr. John, and Mike. And you know what? Let's talk now about why we're here. We have nice people that tuned in to listen to us. And we got Kevin Pilati. Kevin, can you say hi? Can the people hear you?
Greetings.
Kevin's on the background. He's my Symmetry guy, and he's running everything from Command Central. Thank you for your help, Kevin. So let's advance, Kevin. And we want to talk about, first of all, the top stories. And John, we're going to start with you because you're all over the Fed. You're all over the movement of the Fed, what happened. And last year was a big Fed year. Tell us about that, John, please.
Well, the Fed was very active at the beginning of 2023. 2022, we came off a year with quite high inflation. Year-over-year inflation towards the end of 2022 was nearing 8%. So the Fed has been trying to engineer what is known as a soft landing, which is to bring inflation under control while not driving the economy into a recession. And the way they do that is by influencing interest rates. The interest rate they control, or the target, is called the Fed funds. So they raised the Fed funds rate 5 times, last time in July.
Okay.
The rate now stands at 5.5%. So that's why you'll see you're getting higher interest rates on your savings accounts, on your money market accounts, because the cost of short-term funds and the return to short-term funds, which has increased. The good news is that this has been effective in bringing inflation under control. Inflation now stands at the end of 2023 at 3.2%, I believe.
And what was the peak, John, inflation?
It was close to 9% at one time, year over year. So now at 3.2%, and the good news is that employment is still strong. The economy is still growing. So fingers crossed, it looks like the Fed has engineered the soft landing.
There's a slide. Okay, good. We can speak to that slide as well.
Yep. So on this slide, you see an inflation target of 2%, which is the long-term inflation target of the Fed. And then you see inflation in the blue line coming down and settling down above the target. Both the CPI inflation, which is consumer inflation, and the producer personal consumption expenditures, which is just another measure of inflation also coming down. So that's good news. Kudos
This
to
was
the
a big, this was a big impact in the markets. And if we look back, Mike, 1 year ago, if we're doing this webinar 1 year ago,
Sure.
the broad economic outlook, many economists were bearish on the year. They weren't expecting a good year.
Right.
But because this inflation came down, that certainly helped. But also last year, again, this is why we could try to predict markets. We invest in markets, we don't predict them. Because when you try to predict markets, you're a gambler. When you buy and hold and build, you're an investor. But there was also a big story last year, Mike, bank failures. People tend to forget about some colossal bank failures. If we can advance the slide, please, Kevin. There we go. First
Yeah.
Republic, Heartland, Silicon Valley. Talk to us about what happened, how this impacted markets. Maybe this had to do with some of the third quarter. The market teams seemed to dip down a little bit, and maybe it was because of this. And then these bank failures. Did anybody get actually hurt?
No, that's a good point. And not all of these were a direct result of, interest rates rising, but, the case of FTX, that was more crypto oriented. But when you look at banks like First Republic or even SVB, these were all a direct result of the Silicon Valley issue that we had, all the direct result of bond portfolios that were marked down. But at the end of the day, the nice thing about what happened, I don't know if it's nice or not, but even though the expectation that there would be more bank failures, but because the Fed kind of rushed in pretty quickly, I think in some cases within 48 hours and kind of propped up some of these banks, nobody lost any money, even though we did have some of these bank failures. So unlike past periods of time where this has occurred, we had very little in the way of bank failures, even though these names like First Republic or SVB were all over the news. We still had very little in the way of bank failures because the Fed acted very quickly to step in to make investors whole. And so that was a positive for markets. So, and also in the case of interest rates, prevented a lot of people from losing any money. So
again, we start January 23. It's going to be a bad year. It's going to be terrible. Well, then we kind of get inflation under control. Now, of course, the damage is already done. When inflation goes up 9%, prices go up 9%. Then from there, now they're only going up 3%. So the damage was done, but at least we got it under control. Bank failures could have been a big problem. Got that under control. Finally, the last piece of news, John. Let's talk about the global conflict. I mean, at the beginning of the year, we were already in the Ukraine war. Then no one knew there'd be an Israeli conflict in the middle of the year. But these can tend to impact markets, and in the short term they do. And I remember, you could tell me, John, but I remember the market dropping immediately, but then kind of settled down and went right back up. Is that what happened? Refresh our memory, John. And what happens in general when these conflicts? How it kind of scares the market, but then if things settle down, talk about that, please.
You're absolutely right, Phil. There was an immediate reaction, and the markets reacted negatively to the continuing war in Ukraine and the new conflict in the Middle East. And in general, markets will react negatively to an increase in uncertainty. And that uncertainty could be, at the root of that uncertainty can be many things. Certainly, the prospect of global conflict or wide global conflict is something that causes investors to get skittish, and that uncertainty normally is reflected in lower asset values.
But once again, when the dust settles, and listen, there's hostages, it's terrible. But from a financial standpoint, companies are still earning money. And that's really what drives the market in the long run. In the short run, things can bang around the market, can prop them up, can push it down. But at the end of the day, things settle in. Are we still earning money? Are corporations still earning? That's what drives the market in the long run. And so we have a little mantra in our office. It says to build a portfolio that you can live with and then live with it. And that means living with it when you're scared, and not getting too excited when things, go too well, but just settle in and just let it work for you over the long run. So let's talk about, I know we have a slide here about oil prices. John, maybe you could speak to that for us, please.
So energy prices in general are an important input to the productive process and important to us all as we fill our tanks with gas and heat our homes with heating oil and fly on airplanes that are using jet fuel. So it's a tremendous and important input to the production process. Energy prices were on the rise in 2022, very high, and that tends to, for the most part, hurt corporate profits, with the exception of oil companies. 2023 saw kind of a stabilizing and then a downward trend in crude oil prices, which for the most part is a positive for the economy and for consumers.
Good. Okay. So these are some things that impacted 2023 in terms of global news, the Fed's actions, bank failures, bank rescues, oil prices, et cetera, global conflict. Let's just dive in for a second to look at some actual numbers. If we could pull the next slide up, please, Kevin. Kevin Pilati in the background. Kevin, you're killing it. Thank you. Take a look at this. 2023, Mike, U.S. stocks up almost 26% in 1 year. International, 19. Emerging markets, 9. Global real estate, 10. And bonds, we'll talk about bonds later, but they had a good year, 5%, 8% for global bonds.
Sure.
Now, if I say who saw this coming, you guys can both say, well, we did. Who saw this coming?
Well, I would say, Phil, despite the fact that we were coming, in a recessionary period, risk markets were volatile. There was a wall of worry around what was going on, as you mentioned, in Ukraine, in the Middle East. It ended up being what we'd like to deem an everything rally. We had a strong year overall, but I think what really made the year was 4 very strong months that basically made the year. So it was a volatile year, yet amongst even the wall of worry that we had, investors that stayed patient and disciplined were rewarded for that. And I like to point one thing out, Phil, because I know how you like to point out things about the 60-40 portfolio and the diversified portfolio. If you look at that green chart there on the screen that has all those bars, you know what that is, right? That's the 60-40 portfolio for the last 73 years. What do you notice about that? What do you notice about that chart?
There's a lot more up years than down years.
There's about 83% of the time a 60-40 portfolio has made you money. And I think that's important, that, again, the disciplined investor, despite volatility, despite all the wall of worry that we incur in the investment world, a balanced portfolio that is globally diversified has done very well over that time frame.
And you said 2023 was an everything rally, meaning everything went up. Well,
yes.
2022 was a nothing rally, right? Everything came down. So it's kind of all or nothing over a 2-year period, which is important because watch, we want to talk about the Magnificent Seven.
Yes.
How about if we go there and we see these names: Amazon, Apple, Tesla, Alphabet. Who were the other ones there? Microsoft.
Yep. NVIDIA.
What's that squiggly line one there? What's that circle one there?
Meta.
That's
Meta. Okay, Meta. That's right. Okay. Anyways, these are the Magnificent Seven. Now, Magnificent Seven, and even where it says right there, John, they lost 40% in 22, but then they jumped back up over 75% in 23. So talk to the people that were frustrated in 22. Get me out of these 7. They're magnificent nothing. You should see what my portfolio looks like. I'm done with you. All right. But the people that stayed with it. Now, these are extremes. The standard deviation on these 7s over through the roof. The standard deviation on a 60-40, is going to be the highs and lows this much. But talk about why this is important to have. Watch this. A piece of your portfolio connected to companies like this, not your whole portfolio.
Yeah, it's a really good point. Important point this year is beginning of the year, the market returns in the beginning of 2023 were driven by and large by these 7 technology stocks in the US. Did wonderful. As Phil pointed out, in 2022, they were leading the charge to the losses. 2023, they're leading the charge to gains. They're very volatile when held alone. Probably more volatile than most investors can take a portfolio of these 7 stocks. So you want to have these 7 stocks and all stocks be part of your portfolio. So how do you do that? You diversify across the US, across all sectors, including technology. You diversify across the world. The Magnificent Seven is still a part of your portfolio. You still benefit from when it does well, but you're not overly punished when a sector, a particular sector or a particular country, or even a single stock does poorly.
So let me ask you this, John. In a symmetry 100% equity portfolio, no fixed income, somebody just has that stock with symmetry. Give me a ballpark. What percentage of that portfolio would be made up of the Magnificent Seven?
Of the 100-0 equity portfolio? Yeah. I'd say less than 10%.
Okay, and that's acceptable. And in a 60-40 portfolio, it'd be 6%.
That's right.
So we have exposure to these companies, and I like to talk to our clients about, I always ask them, you clients know I do this. I said, who's the chef in the house? And somebody raises their hand, right? And when you cook, I said, did you ever use Tabasco sauce? Well, sure. I said, well, you don't drink it out of the bottle like we did in college for a dare. You sprinkle it on. You put a little bit of it on. It gives it flavor. And that's what these are very aggressive asset classes. We're not going to put more than 10% of your stocks into something like this. That means there's 90% that are in everything else around the globe, US, international, emerging markets, real estate, et cetera. We like to have a little bit of kick to the portfolio, just not too much. And let's go to the next slide, because this really gets into, I think, what happened over the 2-year period. Mike, why don't you speak to this?
Yeah, I mean, as bad as those Magnificent Seven were in 2022, and as great as they were in 2023, you got whipsawed because in most cases, and this is just a cumulative return over the last 2 years, Phil. But what we do know, despite the fact that you see Tesla there down 29% over the last 2 years.
So let's explain this. So that means if you held Tesla, bought it 2 years ago, held it, you're down 29. Meta,
right.
You're up 5, right?
Right. Yep.
But the other ones, people don't know what an NVIDIA is. Explain to them what that company does.
NVIDIA, I think, is really involved in the whole AI phenomenon that's going on, and they're that's been a place where besides technology, I guess you could call it technology, but it's an offshoot of technology in that a lot of money is poured into NVIDIA, and they've become the new darling. I don't know if are they officially in the Magnificent Seven, John? I'm not quite sure if they're actually officially in, so they're in there.
Yeah,
but and they're the new darling right now. And the challenge, as you mentioned, Phil, is that all these stocks are great to have in a portfolio, but if they're by themselves, you're taking tremendous risk because these stocks are what we call priced for perfection. What that means is if they don't meet or exceed expectations, there could be, in some cases, disastrous results, which means the stocks don't meet expectations, they go down. And that's always a challenge with these types of stocks because they keep going up and up and up. At some point, valuation will matter, and will, so that's why you want to be diversified. But the point I wanted to make here is that despite the fact that some of these are up positive, as you can see here over the last few years,
three of them are negative over a 2-year period. Alphabet, Amazon, and Tesla are all negative over a 2-year. They had a big 1 year, but over 2 years they're negative.
Right. And it's always challenging because people, have recency bias and want to buy into these types of stocks because they've seen how well they've done. But you have to be very careful because you might be buying in at the wrong time. So that's why we like to be diversified. We like to own all of them in a thoughtful way.
Excellent. Well, let's do this. Let's talk for just a little bit about fixed income, and then we're going to talk just as we close about one of my favorites, the periodic table, and then we'll close. So fixed income, wild ride. Let's go back a year ago, 2022. Okay, John, stocks, well, that's 23, but I want to talk about 22 for a minute. In 22, interest rates shot through the roof quickly. So the value of bonds went down, meaning, so I like to explain this. If you had a bond that was a $100,000 bond, and you bought that bond at 3%, now rates are 6%, and you try to sell your bond, that's why your 100,000 bond is only worth 90,000, because someone said, why don't I want your bond? I'll go buy a new one for 6%. The reverse is true. When rates come down, your $100,000 bond might be worth 110,000 now. Now, if you hold the bond to maturity, you get what it's worth. But in the meantime, but it's important in a group like Symmetry, you have a bond portfolio, meaning that there's always bonds coming due. And as they come due, we reinvest at higher rates in this case. So can you explain then why, John, to help people understand, 2022 was a terrible year in fixed income. Remember, instead of an everything rally, it was a nothing rally, including bonds. But then it came back nicely in 23 as rates started to come down a little bit and as bonds came due and were reinvested at higher rates. Can you fill in some gaps on what I just said?
Sure, that's actually, Phil, a very good explanation of the inverse relationship between interest rates and bond prices. Couldn't have said it better myself. So what happened in 2022? The Fed sets short-term rates. They don't set the 10-year Treasury rate or the 30-year Treasury rate or mortgage rates. Those are set by the market. And the thought on those rates is that they take in the expectation of future rates and future inflation. So in 2022, there was a lot of fears of long-term inflation being persistent. This made interest rates rise, especially on the short end of the curve, but also on the long end of the curve, those 10, 20, 30-year bonds. Now, when it looks like the Fed is starting to engineer a soft landing, the fears of inflation in the long term subside, and those long-term interest rates start coming down. Even though they really haven't come down on the short end yet, the long term, which incorporates the expectations of the future and future inflation, are starting to come down. So your bond portfolio, which has long dated bonds in it, when those interest rates fell in 2023, you did really well. When those interest rates rose in 2022, you didn't do as well. Right? So that's the bond story.
In this slide we're looking at right here, it shows the volatility intra-year, where bond prices were down, yields were down and up, and kind of flat from January through July. Then they went up from a little less than 3 to 5%, settled back down. So the net result of this was about a 5% return in fixed income for the year.
Yeah, and the other part of the fixed income story is that as the economy got stronger, the risk of default of corporate issuers decreased, and that makes those bonds more valuable. So if we look at something called the credit spread, the credit spread's narrowed, which makes existing bonds, existing credit bonds, be more valuable.
So in a normal world, you're going to have stock prices that go up. Let's say bond prices might level out, go down, and then stocks go down, bonds go up. That's a kind of a normal year. In 2022, everything down. In 2023, everything up. So we hope we're going to settle into more normal. And so we talk about, for example, you just used the term 60-40, which is 60% global equity, 40% global fixed income. So the global fixed income historically is not going to give you the return the stock does, but it also has a much lower standard. It helps to bring the risk level down.
Yeah.
So as we're getting a lot of our clients that are retired right now are in 60-40 portfolios, and they're taking little pieces out of their portfolio to live on, but they don't want the risk that their kids should be taking in 100% equity portfolio because they got years to go. And as we, get moved through that cycle, maybe you're 20 years away from retirement, you're in an 80-20 portfolio. And, and again, not all of our clients, but a lot of them are 60-40 in their retirement years, but for different reasons, people can have different allocations. But that's kind of like the standard, So again, just a little bit of what happened on fixed income. Let's look at this periodic table as we kind of the last business slide we'll look at.
Yep.
And Mike, let's talk about this. This looks like my grandmother's quilt, right? And there's a lot going on here. But if we just
Sure.
identify, for example, why it's so important. And Kevin, can people see my arrow here? Or is that just me?
No, we cannot see it.
Okay, all right. So let's do this. Let's find that purple. Go back to 2010. Purple is U.S. real estate. Look how well purple did in 10, in 11. Not so bad in 12. Middle of the pack in 13. Crushed it in 14, 15, 16, 17, 18, 19. Kind of middle of the pack. 20. Oh my gosh, COVID hit. Global commercial real estate got crushed in 20. Pop back up in 21. You'll have to explain why. 22 back down again. Here's an asset class that's all over the place. Good luck trying to pick when that's going to go up or when that's going to go down. But when we have that as a small piece of a portfolio, it tends to work out. But why, for example, Mike, help me. Why did commercial real estate, we know why it got hammered in 20. Why did it do so well in 21?
I think because it got so hammered in 20. I think that basically, that's true. It's, if you're in the real estate business, you're always looking for bargains. I mean, this is the way I think about it is that you're always looking for bargains. So when something is on sale, you buy it. And I think we had a rally in 21 coming out of COVID. Things seemed to be better. So real estate was on the rise until they realized that maybe the rebound wasn't as great as it needed to be. But you could talk about any one of these asset classes, Phil, on the screen here, right? And we typically will say it's, the returns of asset classes are random. It's very difficult to predict what the next best performing asset class is going to be. And so we, in our thought process, we don't try to predict. We try to own them all. And it stands to reason if you own them all, you're never going to be as good as the best, and you're never going to be as bad as the worst. You're going to be somewhere in between, and that's what we strive for. And
look,
depending on
let's draw our clients' attention to the red. The red bar is kind of, see how red kind of goes down the middle of the page. It's never the top 3. It's never the bottom 3. That red represents a 60-40 portfolio of all of these asset classes, 60% towards stock, 40 towards bond, which is exactly what we're trying to do. Now, in Pittsburgh, if you're a Steeler fan, we're kind of tired of Mike Tomlin saying the standard is the standard, because the standard lately has been like 9 wins, 8 losses. We snuck into the playoffs, got our butts kicked. But in money management, the standard being the standard is a good thing. It's good to run down the middle of the page, not to win the Super Bowl in one year and then be 3-15 the following year. 14. We're trying to run down the middle of the page and be consistent. And that's exactly what the 60-40 portfolio does. So I think, why don't we go to the last slide, please, Kevin?
Yeah, Phil, the last slide here gives you the 2023 returns as well. So and it gives you a 15-year average on those.
So look at 2023 and what did the best U.S. growth? And that green's been near the top of the chart. That green, 44% for U.S. growth stocks, did really well in 23. And if you follow that green, it did pretty darn well, except for 22. It was the last place performer. What this chart doesn't show is that green color. If we extended this chart back from 2000 to 2010, John, where would that green color be?
Going back further than 2000, say to 2000?
2009, where was green?
From 2000 to 2009, green was at the bottom for that decade.
We call it the lost decade.
U.S. growth was,
So we don't want to get too hyped up about U.S. growth companies. They did great, and you're owning them, okay? But we don't want to load up on them right before they take a hit. Just keep everything in balance. Everything, keep it in balance. That's the whole point. So if we can go to the last slide, please, Kevin. And What should we do in 2023? Can I say more of the same? The Fed's going to do what they do. There's always going to be geopolitical risks. We believe a bottom line, broad-based diversification across geographies, investment vehicles, asset classes, risk factors is the way to build a robust all-weather portfolio that allows investors to stay the course and reap the long-term rewards the markets have provided over time. And isn't that exactly what Symmetry does?
Yes, that is correct.
And that's why I've been with Symmetry, my dear friends, for 21 years now. My account was first. When I left my job at All American and opened up Henry Wealth, my IRA rollover went to Symmetry. It's been there for 21 years. I'm in the 80-20 portfolio. You still, you're 64. What? I'm not going to retire. There's a sign I'm not going to retire. I'm aggressively investing because I don't plan to pull out of my portfolio until I'm 73 when I have to, and then I'll pay the tax and reinvest. I'm not going anywhere. But my other clients that are my age, maybe they're 70, 30, 60, 40. But Symmetry's been fantastic. And you got all my clients got an example right here today. Dr. John McDermott, really smart guy, runs the research department, coordinates with all the fund companies. And we have a little bit of this, a little bit of that, builds out the portfolios, does the tweaks, is all over it. Involved with new product development. Many of our clients are in the ETF portfolios. Dr. John was big in bringing those to bear. And Mike helps me on the sales side. He's a great research guy. Mike and Greg, super guys. So I'm honored that you guys take time to jump in and speak to our clients. Thank you both very much. You're dear friends. You're solid professionals. I appreciate you guys very much. And to our clients on the call, you're great. You know what? I always try to end these in 30 minutes. We're 33 minutes right now. I'm 3 minutes over. But so we're going to end. But email me with any questions, with any comments. Phil@henrywealth.com. We love you. We appreciate you. John, Mike, thank you so much. Our clients, thank you. Guys, have a great night, everybody. Thank you. And let's stay invested. Let's build a portfolio that we can live with and then live with it. God bless you all. Thanks. Thanks, guys.
Thanks, Phil.
Thank you.